Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs, and today we're diving into a very exciting topic. We're going to be talking about the role of human capital in driving portfolio performance. So today's conversation is really going to center around BMO's new Human Capital Factor US Equity ETF. The ticker is ZHC, and it's a solution that integrates metrics, things like employee well-being, trust, engagement, into its equity selection. So we'll get a little bit deeper into that and what that means for your portfolio. A quick reminder that we're not providing any investment advice or recommendations today. Today is all about education and information. And I'm pleased to be joined today by two members of the Irrational Capital LLC team, the firm behind ZHC. So I'm excited to introduce David Van Aldisberg, co-founder and partner, and Scott Colson, CIO, who are going to walk us through these human-centric factors and discuss how they can really translate into the potential for stronger financial outcomes, which is what we're all chasing. So David, Scott, welcome to the channel.
Delighted to be here. Thanks so much for having us.
Thank you.
David, let's kick it off with you as the co-founder of your firm. I'm hoping you can get into a little bit about what we mean when we say human capital and why this is such an important factor to consider in investment decisions today.
Absolutely. So again, thanks so much. We're really excited to be here. In 2017, we came together on a very simple premise. Having had broad careers in a variety of fields, including financial services, and traveled the world, we heard managers say something, consistently almost everywhere we went, which is, quote unquote, people are our most important asset. People are our most important asset. And so we thought, well, if they're most important, we should be able to measure that. And if they're an asset, wouldn't it be interesting if the relationship between employers and employees were predictive of future equity performance to make that accessible from an investment perspective? So the idea here is, what could be more important than the people who work for an organization? And could we capture it quantitatively and make it available from an investment perspective?
So just like other factors that we look at, dividend value, quality, where we have the metrics that measure it, how can we look at human-centric factors and quantify that? So interesting.
If you think about it, we've all been part of organizations, if we've been employed or worked with other people, where, we're leaning in, right? We're doing a little more. We're excited about the nature of the relationship with our colleagues. We're excited about the purpose of what it is we're doing. That energy is what we're capturing. And then, hopefully not, but a lot of people have been involved in organizations where the opposite is true, and we're leaning back. And what we're seeing is, when you lean forward, when you capture that energy of human capital, it is predictive of future equity performance.
What inspired you to go down this path with the creation of ZHC and, I guess, more broadly, the human capital factor?
Yeah. So, my career spans technology, human capital consulting, and financial services, and the human capital factor is right in the square center of that. The idea is, if in fact this was true, right, could we demonstrate it with large quantums of AUM, that the nature of the relationship, the way people are treated inside of organizations, how they feel about that relationship, if it's predictive, could we make it investable? It's been independent. Our work has been independently verified. So fast forward to today, we have a verified investment factor, and now we have the lovely ETF with BMO. What inspired us to do that is very simple. We wanted to bring these findings to investors to be able to get the alpha that we have found in this process.
You mentioned engagement. I think that's so important. But what are some of the other data points, I guess, that you're looking at, or things that you're looking for that we might not think of?
Yeah, so let me answer it in two pieces. First is, what's the data, right? Like, how do we find this? And the answer is, there's two kinds of data. It is proprietary data. That's data which is only available to us. We fuse that together with publicly available data. Our data set goes back a long way. It's super stable, and it's a lot of companies. And so that's the underpinning. And then the question is, what did we find when we look under the hood of the human capital factor? And the answer is that social science breaks human motivation into two categories: intrinsic and extrinsic. Extrinsic, those things that are outside; intrinsic, the things that are very personal, human, emotional. And what we found is that those emotional elements, trust, pride, motivation, transparency, my ideas are valued, I feel psychologically safe, they light up the board. When companies get that right, it makes an enormous difference. So that's what we found, and that's what the human capital factor is predicated on. We use 100% of the data. We use all of it. We don't have a point of view as to which one of these things is better, and that's how the human capital factor is made.
Excellent. Scott, I want to bring you into the conversation. Maybe you can touch on your role at your firm, first of all, and then I want to get into how you actually quantify some of these things that, from my perspective, sound very intangible, like trust, engagement. So give us the overview there.
Great. Yeah, I'm Scott Colson. I'm the Chief Investment Officer for Irrational Capital. I handle a wide range of portfolio management and research and development activities for the firm. And so when we're thinking about, how do we actually quantify the level of transparency at a firm, or the nature of pride at a firm? And the real, David alluded to this, but we are not prescriptive in any way. So we don't put our finger on the scales and say, this is what's important, or this is what isn't important. So the guiding philosophy for everything that we do is to just let the data speak. And so what that means is, let's imagine a scenario where we have a survey of a bunch of companies and a bunch of employees. And every employee at every company, on a scale of 1 to 6, answers the question, leadership is highly transparent with, what's happening inside the company. And everyone at that company and everyone across every company gives a 4 for their response. There'd be very little information in that question. It'd be very difficult to tell if one firm is more transparent than the other. However, if we have a broad range of responses across employees and across firms, we can then score and group those firms into those that are very highly transparent and those that are not. And you can think about this across every one of the questions that David mentioned. There are many, many questions in these survey tools that are designed by workplace psychologists who are highly trained in this sort of data collection. So these are highly engineered questions to elicit a certain set of information, and that is the nature of the employee-employer relationship. And so once we have this data set across many, many companies and many, many employees, we can then discern levels of trust and transparency, the nature of pride at a company in a quantitative basis, without us inserting ourselves really into that process. And so that's how we determine what seems like are very, very human, emotional, soft-edge things, like a sense of purpose. But once we have this quantitative data, we're then able to systematically rank the universe based on these characteristics.
Yeah, it sounds very intuitive that, highly engaged and trusting and motivated employees is going to lead to better potential performance for a company. But David, what does the research actually say about that link between employee well-being and company performance?
It's pretty stunning. We thought initially that it was going to be a repack, we saw significant alpha, right? We did some testing very early on. We saw some significant alpha, and we thought it was going to be a repackaging of other things. And actually it's orthogonal to those things. It is unique and distinctive of its own. And as you likely know, there's been a great deal of research published about our work, about our research. And so what we find is that when employees feel these emotive connections, there is an improvement in future equity performance. I mean, the alpha is quite consistent, and the performance is very good. We've seen it. This is not just in back testing. This is in actual live performance. And so I mentioned earlier, managers the world over say people are our most important asset. They're right. They're simply right. When you get the relationship correct, right? We've all felt it. It makes a difference in the work that gets done, in the creativity, in the innovation, in the connection, in the productivity, in all the measures that are super important. And we see it, across the board. It's really fascinating. And it's very persistent.
That's the key. And Scott, can you talk to us a bit more about how ZHC, our new ETF, is actually constructed and how you determine what companies make it into the portfolio?
So we have the 500 largest companies in the United States as our starting point. And we're very interested in the right tail of companies, those that are doing human capital management very, very well. And so we look at about the top 30%. So it's about 125 stocks that typically make it into ZHC. And these are the companies that have scored very, very high on their human capital factor score, our systematic ranking of every company in our investable universe. And so what we've done then is isolate, from a security selection standpoint, the human capital factor. But as you know, there are many implementations of factor ETFs, and you can construct portfolios in a variety of ways. We've chosen to be very deliberate about the types of active risk that we're taking. And so from an underlying standpoint, you get high correlation to the S&P 500, fairly low tracking error to the S&P 500 itself. So it can be used not only up as a bottomed up factor portfolio of you've got your value and your human capital factor and your dividend factor, but it can also be used in a sort of general beta replacement category with that extra human capital factor alpha on top. And so what we see is a set of stocks that are then sector weighted to the S&P 500 and market cap weighted within those sectors. And that's how we achieve those low tracking error, high beta, beta of 1 to the S&P. And what that basically means is that you're able to implement this in a portfolio either as a partial replacement for the S&P, a full replacement for the S&P, or as part of that factor mix.
And how does it differ from other factor-based ETFs or even from maybe traditional ESG? Because I think some people might kind of think that this has undertones of ESG in it. So to walk us through that as well.
So while ESG portfolios are typically concerned about keeping the worst offenders out of the portfolio, this portfolio is geared towards alpha, alpha, alpha. We want the security selection to be doing the heavy lifting, which is why it's a positive focused portfolio. We're interested in that right tail, not excluding the left tail. And so that's how it typically differs from ESG implementations. The other issue is that we don't really have a point of view. We let the employees tell us what's important at a company and which companies are doing those important things well. ESG tends to have a very definitive point of view and a set of metrics that are established, and then companies are sort of fit into that mold. We don't take that approach. We're really concerned about the performance of the portfolio rather than expressing some sort of moral or ethical point of view. And then from how it differs from other factor portfolios, in one sense, it doesn't differ from other factors, is very much like a value factor or growth factor or dividend factor in the sense that you're getting exposure to the companies that are doing those things well or that are priced at that point well. So similarly with value, where you're looking for companies that are relatively inexpensive, with the human capital factor, we're looking for companies that are relatively higher quality when it comes to their human capital management. But it differs from other factors from a correlation standpoint. Generally speaking, these types of indexed products that are based on the human capital factor have very low correlation. The most positive correlation being, slight tilt towards growth, a slight tilt away from dividend. So you are getting that differentiated portfolio, but we're talking about correlations in, under 20%, under 10%, positive or negative for those types of exposures. So as David alluded to, it is absolutely orthogonal to those other factors and a core piece of that portfolio construction.
We've done a lot on factor ETFs on this channel, and something that we always bring up is the sector tilts that are inherent to the different factors. So if it's low vol, you're going to see those utilities and those staples in there. What does that look like from a human capital factor perspective?
So that's it's a great question. And one, when we first started out, we thought, oh, we're going to see a big difference between an industrial company and a financial services company or consumer discretionary, right? That, it's just like they're just based on the density of population of, those companies relative to human capital, to the number of people. And what struck us as so interesting is these deeply emotive, intrinsic characteristics, they're important regardless of industry, right? A sense of pride is true for an industrial company located in a rural location, a financial services company in an urban location, a consumer discretionary company located somewhere, somewhere else. At the end of the day, I want, as an employee, I want to feel appreciated. That has that's not distinguished between the energy business, the real estate business, the consumer discretionary business, the pharmaceutical business, and so on. And so that's what's most fascinating, which is that it has this consistency across sectors.
Very interesting.
Two aspects to that, really, right? So we have the human capital factor itself, which doesn't really discern between a real estate company and a tech company, et cetera, as David just said. The second piece, portfolio construction. Since we are sector weighted to the S&P 500, some factors may give you a very, very concentrated sector, active risk against its benchmark. In the case of the human capital factor, in the case of ZHC, that's simply not the case. We look identical to the S&P when it comes to that sector exposure.
That's very interesting. All right. I want to close it out by hopefully getting you guys to share some examples of companies in the portfolio that do exemplify strong human capital performance.
Just like there are the dividend aristocrats who have been issuing dividends for a very long time. We've seen a handful of companies that are consistently in the top of our rankings. Some are the usual suspects. You might expect a company, for example, like Microsoft, over the past 10 years or so to be a high human capital company. And that's absolutely true. But what people don't also realize is that, as we've just mentioned, it's the same in technology as it is in industrials. And companies like Delta Airlines, for example, very consumer facing, high degree of number of employees, facing those consumers. We see that company persistently, consistently, in the top of the ranks as well. And so it's not just limited to, sort of software companies with beanbag chairs or something like that. These are core fundamental aspects of the workplace, and Delta's done a great job there.
Do you find are there any surprises that come up in the portfolio? Like, I know we read a lot about certain companies and the way they treat their employees, and you expect that, maybe their employees wouldn't rank well from that perspective. Are there any surprises that have come up?
The ones that always are just a little bit curious to me, and we look into it, and it absolutely holds. There's no issues with the data or anything like that. But this year we've seen a great increase in our exposure to tobacco companies in several of our products, and that was surprising to me. Went against my assumptions, but there they are. And,
yeah.
And it's performed quite well this year, so we're happy with that.
Fantastic. Thank you so much for both of you for being here with me today. I appreciate the chance to discuss this exciting new factor that we're now giving everybody access to, really democratizing access through the ETF vehicle and through ZHC. So I encourage our listeners to check out the profile on our website, to do your research on Irrational Capital LLC. There's lots of stuff on the Google machine that you can read through on this great organization. So thanks again for being here today.
Thank you. Lovely to be here.
Next week, we'll be back. We'll be discussing asset allocation and the growth and innovation in this all-in-one ETF space. And we'll be welcoming Danielle Nezel back to the channel. She's been a host of this channel for years and is returning from mat leave. So really excited for next week. Hope you'll join us then. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.